Drip stocks are like the slow and steady wins the race of the stock market. Like a drip watering a plant, these stocks give you a steady stream of income over time without having to sell shares or constantly watch the stock market. Now, these do typically pay out dividends, which are a distribution of a portion of a company's earnings to shareholders and will automatically be reinvested into that stock that just paid out the dividend. So one peculiar thing about dripping, which is Dividend Reinvestment Plan, is it forces you to buy more shares at lower prices and less shares at higher prices. And steady and reliable dividend paying companies are also known for being less volatile and more stable compared to other stocks. And the best time to buy stock, which are pieces of an actual business, are when they're at or below their fair value. So we're going to look at the top 3 drip stocks to buy right now because they're undervalued. We'll look at their Simply Safe dividend score, find out how many shares you'll need to be able to drip a full share, and then pop on over to Alpha Spread and look at their intrinsic valuations for the base case and their worst case scenarios. And remember to never blindly buy any kind of a stock because some YouTuber with a neon $100 bill hanging on their wall recommended it. That gets me off the hook, so let's go to stock number 1, which is Altria, ticker MO. They're like a friend who always has a pack of cigarettes on hand, but you can't help but worry about their health. Altria is a company with a long history, but its primary business is a product that is known to be harmful to people's well-being. Now, they've had to adapt and diversify their portfolio in the face of declining smoking rates and increasing regulations, but the fact remains that the core of their business is still cigarettes. Altria provides shareholders with a steady stream of income from dividends, but investing in Altria means investing in a company whose main source of income is derived from a product that causes harm. So despite all this, they are still a major player in the industry and their dividends are consistent. And by the way, before we get into this too much, Simply Safe Dividends does cost a pretty penny, so I'll scroll to the bottom for you and you can pause the video and study these at your leisure. But they do get a 55 borderline safe dividend safety score. Current yield, very, very big, 8.54%. Their last dividend increase was 4.4% in August of 2022, and they are a dividend king with 52 years of dividend growth, but their 20-year CAGR is only 2%, and that's because of when they spun out of Philip Morris. Now, their last dividend payment was December 21st, so it's going to be about until the end of March before you can qualify for their next dividend, but currently $3.76 per share per year, 94 cents a quarter. Altria's dividend yield, remember these are all lagging numbers. This tells us nothing about the future, but it's an interesting gauge nevertheless. That dividend yield is 19% above their 5-year average, and their PE is below their 5-year average. Now, their free cash flow payout ratio is 82%. That's nothing to worry about too much because management wants about that 80 to 85% payout ratio. Shares outstanding, 1.81 billion, so they have been buying back shares, paying increasing dividends with all of that money. Return on invested capital, very high at 48%. Nice free cash flow margin, 43 cents of every dollar is making it to the bottom line in free cash that's coming in the door, and a 10.66 interest coverage ratio. So here we are in Seeking Alpha. By the way, if you'd like to check out Seeking Alpha Premium, I have a link in the description below. Save you 50%, costs you about $119 for your first year. But on Seeking Alpha, you can also do this for free. If you click on the dividends tab, you won't see the dividend grades because you won't have a premium membership like I do. Unless you already do, then you will see them. That last quarterly payment again was 94 cents. So if we plug in that $44.01 and divide it by that 94-cent dividend, you would need 46.81 shares, rounded up to 47, call it 47 shares times that 44.01. That would cost you about $2,068.47 at that current price in order to receive a full share of Altria. And looking at the mighty Mo on Alpha Spread, we see that they have an intrinsic valuation of $54.77 at the base case, making them about 20% undervalued. Again, this is 5 years of flat-ish, like a rat-ish trajectory, but if we do worst case, which is 5 years of declining growth, we see it's about 1% undervalued, and some of the greatest investors like to shoot for a 10% undervaluation of the worst case to give themselves a really big margin of safety. And if you're wondering what most competitors look like, here you can pause the video, zoom in, give yourself some ideas. You can see some things that are undervalued. Number 2, AT&T is a telecommunications giant whose roots trace back to 1876 when founder Alexander Graham Bell invented the telephone. And they're kind of like the ex-girlfriend you can't seem to shake off. Now, they've been around forever and seem to always find a way to stay relevant, but they can be slow to adapt to changes and are known to make questionable decisions. AT&T has been through a lot of changes and acquisitions, and they've had their fair share of ups and downs, but they still managed to be one of the biggest players in the telecommunications game by connecting millions of people and businesses all around the world. Now, despite the mixed feelings, you can't deny the fact that they are still a giant in their industry and their dividends are consistent. So you might not love them, but you can't deny they're still worth keeping an eye on. Here comes T on simplysafedividends.com. They get a safety score of 70, safe, current yield 5.84%. Again, bit of a slow dividend grower because of that cut from right sizing the dividend, as they call it, where they spun out Warner Brothers Discovery, took a chunk of about $20 billion of annual revenue with it. But you see that reflected as that dividend was decreased, right-sized, depends who you listen to, 47% in March of 2022. Now, had I done this video sooner, you could have got in for their next dividend because it was January 9th, but the annual payout is $1.11, and they are coming up very close here on another dividend increase, so we will see if in the spring of 2023 here, they do indeed increase for the very first time. So that dividend is a little bit below the 5-year average, but remember, they had some right sizing going on, but it's still 11% below, but still a healthy dividend. Free cash flow payout ratio 74%. I'd like to see that indeed below 70%, just like Simply Safe Dividends shows. And that free cash flow per share, like a lot of companies, has taken a hit. They're currently at 7.28 billion shares outstanding for AT&T. 9% return on invested capital. It's about mediocre is what they do. They pay that dividend. Net debt 53%, so thankfully they don't have a ton of debt. Everyone dings them for that, but AT&T has debt that rolls out all the way until 2097 and a 5.22 interest coverage ratio. But here comes T on Seeking Alpha. They have dividend consistency of A. Check that out. They get an A because they've been paying that dividend for 34 years and they've never missed a payment. But again, 28 cents, they pay it quarterly. So if we take that $19.02 share price divided by 28 cents, we get 67.92. We'll round that up to 68 shares of good old T times 1902. You would need $1,293.36 to get a share of AT&T at current prices. Here comes T on Alpha Spread. They get an intrinsic valuation of $28.05, making them about 32% undervalued on the base case, and on the worst case, we'd get $15.80, so about 17% overvalued. And as always, intrinsic value is not an exact number. Everyone has different assumptions. It's like a range. I always say it's like knowing somebody needs to lose weight without knowing exactly how much they weigh. So intrinsic valuation is just a range. There is no exact number. And if you look at AT&T's competitive landscape, just about all of them are undervalued except for Swisscom AG, which is a company I know nothing about. So there you go. And our number 3 company here is Enterprise Products Partners, ticker EP. D. Now they are like the ultimate party animal in the stock world. Just like how the life of the party is always the one with the most energy and the best stories, EPD is always the one with the most cash flow and the most exciting projects. They're a midstream energy company that transports, stores, and processes natural gas, oil, and other petroleum products, and they're always on the move, making deals and expanding their operations, and they're just a couple of years away from becoming a dividend aristocrat. It's like they're always the one with the keg and the party never stops when they're around. So if you're looking for a stock that will keep the cash flow party going, EPD is definitely worth a look. I like to party. EPD on Simply Safe Dividends has a safety score of 65 safe. Current yield 7.8%. Again, they've been growing that dividend for 23 years. They're 2 years away from being a dividend aristocrat. Their last 20-year CAGR 6%, which is not bad. Their last increase, January of 2023, 3.2%. Currently paying out $1.96 per share. Current payment $1.96, and depending on when you're watching this, January 30th is the ex-dividend date. Always remember, you're going to have to own shares on the 29th. You cannot buy on the 30th. You will not qualify for that next dividend, which will be 49 cents. And do remember, you get a Schedule K1 because they are an MLP, and as you can see on the screen, there is a little bit of a tax liability that goes along with that and some special considerations. Won't get into it in this video, but do be aware. And EPD, they're 7% above their 5-year average dividend yield, so they're about in line with that. We don't look at free cash flow payout ratios for companies like EPD. We look at the distributable cash flow, which is 57%, so very healthy, very nice for EPD. Their DCF per share, distributable cash flow, is up and to the right, $3.43. Sales growth 53%, looks nice. Now do not worry, they are diluting shareholders. I say diluting. They have to earn money and bring money in for new projects and whatnot, but we do want to see, like, these sales have been choppy, but we want to see them up and to the right, so do keep an eye on that. Net debt 52%, nothing too crazy, and their interest coverage ratio, which means they have $4.92 of operating income to pay for every $1 of interest expense. ICR is an important number, so EPD does not have a dividend consistency grade from Seeking Alpha. Very interesting. Remember, that was 49 cents a share they pay every quarter, so let's see how many shares you'd need. Remember that $25.14 divided by 0.49, you'd need 51.30 shares. I always round it up to be safe, so we'll call it 52 shares times $25.14. You would need to spend $1,307.28 at current prices right here today in order to get one free share dripped, one full, free, and clear share of EPD drip to you, the account holder. And hold my beer as we come here and look at EPD on Alpha Spread. $42.04 is about 40% undervalued in the base case. Worst case, $27.53. That's about an 8% undervaluation. So right in that range of what some very, very famous super investors look for, to be 10% below worst case for that margin of safety. And almost all of their competitors look like they are undervalued. And if you need any more push, check this out. At the insider trading, there has been a whole lot of buying going on with EPD over the last 3 months, 3 to 6, 6 to 9, and 9 to 12 months. So the insiders are buying EPD, and I think I will be buying more EPD as well. Now, I am wearing a Lockheed Martin ticker LMT shirt because I love the company, and they are included in the next thing that I am buying to get from 0 to 100 shares of in my Roth IRA account. So if you'd like to find out exactly what has 2 thumbs and is buying, click this video. That didn't work well. Next to my head. And if you click that box floating next to my head, I will talk to you there.